Follow-on public offer, also called FPO. What is the meaning of FPO and how is it different from IPO? We shall discuss this. When an already listed company wants to sell more shares to the investors, it does so through follow-on public offer. Now, there is a company who has already issued shares to the public. Now it wants to issue more shares to the public. Again it wants to issue more shares. It is not the first time. So already listed company. Why is it already listed? Because it has already issued shares. When you issue shares, you get listed on the stock exchange, right? So when you have already issued shares to the public and you want to make a fresh lot of shares to the public, you are offering another subsequent lot of shares to the public. That is called follow-on public offer. FPO is made by the issuer company that has already made an IPO in the past. So, making an IPO in the past means initial public offer has already been done. The shares have already been issued. The people have already subscribed to the issue. So, it will be done by an already listed company A. It will always be done by the issuing company who has already made an IPO. These are interdependent things. This is one and the same thing. Already listed company means already done an IPO. Now it wants to make a further issue of securities to the public. This is called FPO. Now the question arises, why? Why will it sell more shares? Why will it offer more shares? Because company wants more capital. Company wants more funds, either for growth or expansion. You are making more projects, you are buying more companies, you are creating more building, more machinery, you need more funds. Or it can also be there that the issuing company wants to restructure its capital by reducing the debt. Now the company wants to shift the debt, reduce the debt and move to equity structure. So it raises equity capital through fresh issue of capital. This is in FPO. Now when you will get the funds from issuing equity shares, you will repay your debt. So what will the company do? The company will reduce its debt. Company may want to reduce its debts because it wants to get rid of the interest charges, the monthly installments. It wants to get rid of its burden liability of interest. And company does not want to go in the debt trap. So therefore, the debt structure is shifted to equity structure. Now, FPO and IPO, they may sound similar, but they are different. IPO is issued when a company sells its shares for the first time. It's your first entrance exam, your first time. This is called IPO when the company will sell its shares for the first time. A private company launches IPO, it becomes public. When that previously, if it is a private company, the shares will be held by the owners or the friends or the relatives or a limited number of people. When that private company will become public now by issuing shares to the public, it will launch an IPO, then it will get listed. Once it will launch the IPO, it will get listed on the stock exchange. It is asking for funds for the first time from the public. Unlisted company will issue IPO. Until and unless IPO is issued previously, the company will be unlisted. Once IPO is launched, only then it will be listed on the stock exchange. So, before IPO, it is not listed. But what is FPO? FPO is the subsequent public offering. Already listed company will issue FPO. क्योंकि IPO तो हो गया ना. IPO has been launched. Initial public offering has been done. So they were listed that time. Now when subsequently you will be offering shares to the public, so you will be already listed. A public limited company offers FPO, right? FPO are the supplementary issues and are often offered even as the shares of the company are traded on the stock exchange. When a company is issuing IPO, the shares are not yet traded on the stock exchange. But when a company is issuing FPO, follow on public offer, the shares are already being traded on the stock exchange. So this is the difference between the two. See, both FPO and IPO require the company to fill offer documents properly and the offer price is determined by the book building process. The issuer company will set the price band within which the investors can bid. But typically, this price band in the case of FPO, it is set at a discount to the market price. It is generally set at a lower than the market price in FPO. Now, there are two kinds of FPO. One is the dilutive and the other is non-dilutive. First, the dilutive one, where the company wants to raise money from the equity market to pay off debt for expansion activities. I told you in the previous slide that why is it raising money from shares? Because it wants either A, to pay off the debt to reduce the debt burden, or it wants to expand its business. Growth and expansion could be another cause. You may be constructing more buildings, more factories, buying other companies, whatsoever. The point here is when the company is issuing fresh shares. For whatever reason, these reasons are a separate thing. When they are issuing fresh shares, it is called dilutive FPO. Because when you will issue fresh shares, more shares will be added. Fresh shares are created and then they are sold by the company. The number of total shares will go up, obviously. Therefore, the earnings per share will get diluted. Previously, there were say 1000 shares. Now, the number of shares will increase to 1500. So, the earnings per share will get diluted. This may also lead to the decline in the price of existing listed shares. Already listed shares, you may feel that there is a little decline in the price of those shares. If you see the history of even say Reliance, when they issued FPO, little loss or a little reduction of the price was being examined there. But then it will come back to normal, not a problem. But my point here is more shares are added, number of shares will go up, earnings will get diluted. Alright. Now the second is non-dilutive. When the existing institutional investors of your company, the venture capitalists, the promoters or the company executives, these four type of people, they may want to sell all or a part of the holding. They are going to sell these shares in the market. Previously, these four people were holding these shares. Now, those shares which are held by these four people, they will be sold in the market. No new shares are created. Here I told you more new shares are added. Here no new shares. They were held by these people. They are selling it to the public. Therefore, this is non-dilutive FPO. The earnings per share do not change because the number of shares are the same. Just the ownership of the shareholders will change. They were lying with the venture capitalists, they were lying with the institutional investors, and now they are with the public. That is the only change. So the earning per share will not change. No new shares are added, but the price of the listed shares could still go down. Why? Because investors, they will take advantage of the price arbitrage. Now, what is the arbitrage? We've made a separate video. Kindly go and have a look on that video. The investors will take advantage of the price arbitrage. They will buy the shares which will be offered on the FPO at a lower price. I told you in the previous slide that when FPO is offered, a little discounted than the market price is being offered. So, these arbitrage, in the point of arbitrage, the investors, they will buy during FPO at a lower price and later they will sell it at a higher price. They'll make money out of it. When this arbitrage will vanish, then the price of listed shares will come down to the level of the fixed issued price. It will get balanced. Okay. So here I come to the end of the article. I hope I have made the things very clear to you. In case you have any doubt, please feel free to ask me in the comment section. Like and subscribe to my channel. Thank you for watching. Stay safe, stay blessed.